Klarna is in trouble. The company that pioneered the buy now, pay later trend, which has pushed so many into debt, seemed to be on top of the world. A $17 billion IPO, growing revenue, millions of new active users. Now, it's collapsing. Their stock is down 60%. Their profits are even worse. But something even weirder is happening. Klarna is evolving into something else. Something much bigger than just buy now, pay later. Yet, investors aren't impressed. And now, Klarna is facing a major lawsuit for a potentially misleading IPO. Klarna is finally getting what they deserve. Our last video on Klarna ended on a very important moment, the IPO, which they had delayed because of how bad things were looking. On the surface, things were looking pretty good. They passed 100 million active users. Plus, the longer customers use Klarna, the more often they use it, from 2 times a year when they sign up to as high as 18 times a year after 6 years. The momentum is undeniable. We're outpacing competitors, our merchant network is scaling rapidly, and our next-gen products are reshaping money management for millions. But Klarna was caught in a pretty ironic spot. Klarna is basically the face of buy now, pay later. A merchant will add Klarna to your checkout and pay them 3 to 6% as a commission. They then offer the customer the option to buy now and to pay in multiple installments, pay in 30 days, or financing options as long as 36 months. The most common way was to pay something in 4 installments though. But there's one crucial detail. Klarna fronts the payment for the merchant and takes on the debt of what the customer owes. So they still have to get that money back from the buyer. Though this is how they make money. Failed payments charge $7. Their debt has particularly high interest, as high as 35.9%. They were even dragged into court for charging €1.20 just for a reminder email. Klarna is essentially a debt collection company, just with good branding. But this business model creates some problems. Even when Klarna reports huge revenue, huge growth, and 100 million users, they still have the problem of that debt. In 2025, customer credit losses increased by 17%, totaling 136 million. This means more customers are failing to pay back their debt. When Klarna pays merchants upfront, they typically do this with their own debt. But with fewer customers repaying their debt, Klarna's debt is getting more expensive. Debt financing expenses climbed to 130 million in Q1 2025, up 15%. Keep in mind, that's not Klarna's debt. That's the cost of their debt, like interest. Ironic as it sounds, Klarna has fallen into their own debt trap. Buy now with the debt and pay it back later. $130 million cost of debt for just 1 quarter, which is slowly rising. It makes you wonder how massive Klarna's actual debt is. Buy now, pay later users are also disproportionately financially vulnerable compared to other debt. A study this year found that 41% of customers had been late on a payment, up from last year. This is why, despite their EBITDA saying they made $3 million in profit on $700 million in revenue, they actually lost $99 million in 1 quarter too. Not only is this ethically questionable, but it also causes these problems for Klarna. But that brings us back to potentially the most important moment for Klarna. The IPO along with CEO and co-founder Sebastian Siemiatkowski. They had delayed their IPO, which they said was due to tariffs. But I think he knew the buy now pay later model wasn't sustainable, at least on its own. With how Klarna's outlook was, I don't think an IPO would have been hugely successful. They needed a story for Wall Street to buy. That's why Sebastian had even bigger plans for Klarna. He's had plans for a huge pivot into something else. So Klarna began moving ahead with their IPO. And it was a huge success? In September 2025, Klarna went public on the NYSE, priced at $40 above the guidance range of 35 to 37. Demand exceeded supply by roughly 25 times. Shares opened at $52 and closed first day at $45.82, up 15%. At closing, Klarna was valued at $17.4 billion, raising $1.37 billion total. To outsiders, this seemed like a total home run, like all the worries about Klarna were gone. But not exactly. Look at this graph. Their market cap is down more than 50%. The price is even lower. Something weird is happening, and now Klarna is facing a major lawsuit because of this IPO. Klarna has been rebranding into something bigger. If we look at their IPO, they describe themselves as the global digital bank and a flexible payments provider in the first line. The second part is what Klarna actually does, flexible payments. So, what's with the global digital bank? Klarna is changing, and not everyone's happy about it. Let's go a bit deeper. The same week Klarna filed for an IPO, it partnered with the company OnePay. That's basically Walmart's payment company, and Klarna is now the retailer's exclusive buy now pay later provider. Prior to this, Walmart exclusively used Affirm, who has now been dropped. Choosing Klarna as their exclusive installment loans partner at Walmart in the US is a huge vote of confidence as we pursue our goal of being available everywhere for everything. But something about all this is weird. First, Klarna issued OnePay warrants to acquire 15.3 million Klarna ordinary shares over 5 years, with an average price of $34 each. That basically means Klarna essentially paid Walmart in stock for the partnership with a cheaper share price, which means they really wanted this. At least it was a cheaper share price. But that's not all. Repayment options are 3 to 36 months, with interest rates reportedly ranging from 10 to as high as 36%. Those loans are long and with interest. In 2024, Klarna said 99% of transactions on its network were interest-free, but no longer. Klarna has been slowly trying to pivot into larger, regular banking, specifically through what they call fair financing, those longer-term installment loans typically spanning 6 to 24 months. Basically, more of the normal interest-based loans, and Walmart was just the beginning. In 2025, they also launched a debit card as it looks to diversify its business beyond short-term credit products. And when did they do all of this? Right before their IPO, which they refiled in September and rebranded themselves first as a global digital bank. Klarna is like a bank, but they still aren't? Klarna does have a full banking license in the EU, but not in the US. So they aren't, but they can offer FDIC-insured deposits and withdrawals, aka like a normal bank. How? They go through a partnership with WebBank, a small financial institution based in Salt Lake City, Utah. We are basically a neobank to a large degree, but people associate us still strongly with buy now, pay later. They're doing this because getting your own US bank charter is so slow. But this partner bank model gives them 90% of the benefits with none of the hassle. It's the banking as a service route. WebBank holds the actual charter, Klarna rents it. But why do this? After all, the US banking industry is very competitive, with giants like JPMorgan Chase and Bank of America. Well, this might be Klarna's only choice. First, buy now pay later loans have terrible margins. The loans were short, small, and usually have no interest. But interest in finance is the real moneymaker. Plus, we know the rate of late payments was rising, which likely hurt Klarna's cost of debt and profit. And then there's the second reason. I don't think nearly as many people would have invested in Klarna if they didn't have a plan like this. Pivoting to a digital bank, that's something you can sell to Wall Street. So the question is, did it pay off? We just passed 900,000 subscribers, and I wanted to say thank you. Thank you for watching our videos. We put a ton of effort into them. If you're not subscribed, maybe you can help us get to 1 million. We know the IPO was a huge success, but after that, things turned sour pretty quick. Even if Klarna isn't technically the real bank here, they still hold the credit risk for this fair financing. Instead of just short-term loans, it's long-term ones too. Higher revenue from interest and more customers, but also more risk. A few weeks after the IPO, Klarna released their Q3 financials. Gross merchandise volume, or GMV, was 32.7 billion, up 43% thanks to rising long-term loans, plus 4 million card signups. Revenue was 900 million, up from 706 million year over year. But net income was a loss of 95 million, down from a profit of 12 million year over year. And the more important number, TMD, transaction margin dollars, aka Klarna's profit on transaction after the direct costs of funding and servicing the loans. This is basically the key to whether Klarna's core business is working. This was 281 million, down from the same quarter the previous year. But Klarna was confident, so they projected TMD would grow to 390 to 400 million next quarter. Then came Q4 2025, and Klarna outperformed its guidance projections in revenue and GMV, but not TMD, though they did come close, 372 million. This quarter's transaction margin dollar result did not land where we guided. We take that seriously. The acceleration in lending growth is the primary driver of that outcome. Klarna missed their own projections, but for a really ironic reason. Fair financing grew faster than Klarna's own forecast, and that faster growth is what caused the miss. Based on the nature of fair financing, those long loans, they have a big upfront cost, but that profit lags quite a ways. In that quarter, there were 2.5 billion in new loans, which had 80 million in upfront losses with only 40 million in upfront revenue. This is what's hurting Klarna right now. More of this long-term debt than expected. The actual income from interest and such on that 2.5 billion, Klarna won't see for a while, which is expected to be 180 million. That is, if borrowers pay as Klarna expect them to. Just because you own lots of debt with potential earnings doesn't mean it's guaranteed. The stock by this point was down more than 75% from their IPO, but something unexpected just happened. In Q1 2026, Klarna finally reported positive income of $1 million on revenue of $1 billion. TMD was 389 million, more than last quarter, but not by much. Same goes for GMV too. Fair financing and being a bank was the story for the next big step for Klarna. But is it really translating into more profit? Well, many don't think so. Even after a sliver of profit, the price is still flat. Maybe there will be more profit growth, but so far, the growth prospects aren't great, and there are other problems too. On December 22, 2025, a shareholder class action lawsuit was filed against Klarna, claiming the company misled investors during its September 2025 IPO by downplaying credit risks in its buy now pay later lending business. Just weeks after the IPO, Klarna reported a staggering 102% year-over-year increase in its provision for credit losses, causing shares to plunge well below the $40 IPO price. When a company's credit loss provisions double almost immediately after going public, it raises serious questions about whether the IPO documents were truly transparent. Klarna, in response, of course said, "We believe the allegations lack merit." The lawsuit is ongoing, but it's pretty clear many aren't happy with Klarna's choices. And given how the stock essentially nosedived after the IPO, it's understandable. One of the weirdest parts about Klarna, though, is actually their obsession with AI replacing humans. But these aren't working as well as many thought. AI customer service and AI layoffs are actually backfiring for a lot of companies, and many, including Klarna, are starting to regret it. Click here to learn the rest of that story, but until then, I'm Hari, and I'll see you guys on the next one.